Hello and welcome to this week's edition of the Fit Finance Sessions with me, Henry. Tim and Tom as well have joined me today. And I thought I'd start by telling a little story of what happened at the weekend. And that was I went to the pub. Now, that's not much of an unusual event in my world. But what was unusual this time was I went to 5 different pubs on the same night. And the first 4 of them refused to serve me a drink. Now, I hasten to add, I hadn't drunk too much by this stage, but the first one I went to, they closed at 8. The second one I went to was too busy and with too few staff to serve me a drink. The third one closed at 8. The fourth one, like the second one, was too busy and they didn't have the staff to serve me. And so it took until we got the fifth one before I could have a pint of Golden Hen, which I must say, by the time I got it down me, was sweet relief. It seems to me odd, though, that these pubs are, one, closing early in the day, or earlier than they need to, and secondly, that they seem understaffed, with all the headlines that the industry has created over the last year. You'd have thought that they'd be absolutely gagging to serve me as many drinks as I could take. Any thoughts on this, chaps? Why the pubs might not have the staff that they need, or might not want to be serving throughout all the hours that they could potentially be serving at?
I think some of them are right sizing the business and not. If you're not sure of demand, then you don't want to be hiring too many people. But it's definitely demand is there. I mean, Tim and I went on a similar venture on Friday as well, and had the same result. So I think, what's been reported in terms of unemployment and what's actually happening in reality. I think what's the thing about stats? 95% of them are made up or made to fit whatever the argument is. So we'll probably come up with some more stats for you in just a few moments' time. But I think this comes onto the inflation topic we've been talking about, and inflation should come through. The detractors are saying, oh, it'll just be transitory, short period of time. But it's when wage push inflation comes through, which is people demanding more wages. So if you've got people running businesses that are struggling to hire or can't deal with the capacity, then people can demand more wages. And there was an article in Bloomberg last week about Chipotle Mexican Grill in the States, so a fast food type place, having to significantly increase wages to attract staff back into employment. So if you've been watching the news, apparently everyone is jobless and unemployment is huge, and there's a big pandemic going on, which, okay, yeah, there is. But if firms are having to increase prices to entice staff, then I would say unemployment isn't as bad as what it seems. But I think, Tim, you've got some views and news on that as well.
Yeah. I mean, just more on the inflation topic really, rather than unemployment. But yeah, I mean, it's been sort of the chat of the financial world for some weeks/months now, hasn't it? Inflation, as you say, it should come through. Obviously, a certain amount of inflation is healthy, but it's the spiking which is what's trying to be avoided. The main concern as to why, at least for the last week or so, why my markets have been or down, if not sort of sideways, is because month on month for April's figures in the US, inflation was more than double what it was forecasted to be at 0.8 for April rather than 0.3, I think it was forecasted to be, which clearly isn't great. And that was the biggest jump in some years, I believe it was, on a yearly basis, over 4%, which is clearly more than double the Fed's target. So that's sort of the, oh God, what's going on? Is it happening now type thing? But actually, I mean, going back to what you were saying a little bit ago, I was reading an article not too long ago about actually drilling down into the components of the inflation reading and looking at the nuts and bolts of it. You can understand why, for example, transport related those sorts of components of it. Naturally, as sort of the car rental companies in the US particularly, they sold off the majority of their fleets, what have you, at the beginning of the pandemic, whereas now everything's obviously being lifted a little bit more, so they're buying back up the stock, etc., which is pushing pushing the prices up and contributing to these rises that we're seeing, which that's not going to happen month in, month out. So there is a sort of potential scenario where it's just a starting up symptom, if you like, of the economy, of people just starting to buy things back up and ready to sell on. But only time will tell, I guess, clearly, as it always does. But I think it's the nothing to worry about for now type thing is what that side of the fence is arguing.
Yeah, I think I think central banks are trying to say that, aren't they? It's all just transitory, it's short term. I think, we've talked about a K-shaped recovery. Some companies are winning, some are losing. And I think some things are inflationary at the moment, and some are, if you look at all the tech, Zoom, a lot of those things are deflationary. People aren't having to travel so much. And I think that's what we're saying. Sometimes some of the best investors will say that you've got to just go outside your door and stop looking at data, because particularly if you're looking at year-on-year data, if you're comparing it to last May in the pandemic, then it's a very different scenario to what it is today. So data and then what's actually going on in the real world is sometimes two very different things.
But I think fundamentally that you're right, that in the sense that consumer inflation will suddenly pick up, right? Because we couldn't go out last year, we weren't going to restaurants and da. So of course that will suddenly flick up, and we'll see a lot more of that coming through. But the other thing that will be causing inflation is a huge stimulus that's being provided by central governments across the board, and whether or not be in the US with what their $2 trillion of stimulus, or in the UK with slightly scaled back version of that. But just pushing all that money into the economy, whether or not that's creating jobs because more roads will be built or hospitals will be put together or what have you, injecting that money into the system is going to create inflation. So I see there being two parts: one that is transitory, and one that'll be that'll be around for much longer, because the stimuli is not going to be here and gone tomorrow. The stimuli, these are 5-year, 10-year packages of money being shoved into the system, and that will cause inflation over the medium term, I reckon.
I'm not very scientific. I think Tim did physics in school. He probably knows better. But if you put energy into something, if you think of money as energy, it's got to go somewhere, hasn't it? So that's going to come through. There's going to be a reaction. You can't just make money appear and nothing kind of happen of it, whether that's good, bad, or indifferent. If you pump a load of something into somewhere, then there's going to be some outcome at some point. And I think it's just how quickly, how fast that happens. But hopefully in some ways it gives active management. What we're talking about here is really more volatility. There's more, everything's been stable for quite some time. And I think hopefully active management can maybe identify some of these trends and try and pick winners and losers. And you'll get more volatility because of being active, but there's also, for every bad outcome, there's always an opportunity at the same time. Fingers crossed we're all in the good opportunity basket.
Fingers crossed. I'm sure the boys at Portfolio Metrics have got their finger on the inflationary pulse around the world, and will be doing all they can to find those managers with the answers to that question. Any more, chaps, or should we wrap it up for this week's episode?
Other than hopefully you haven't held Bitcoin for the last week, so that's gone well, hasn't it?
No, shut up. Interestingly, but they do say Bitcoin is a store of value. So in inflationary times, Bitcoin should be the coin to hold, provided Elon shuts his cake hole.
On that note, actually, I don't know if any of our old school listeners are still listening, but if you recall, I said back in December last year that Bitcoin had reached its highest level of correlation with gold, and how it was, back then it was this idea that it could be pushing itself into this digital gold, or as you say, silver value position, which it seems to be at least at this point.
Because
value right now, but some value.
Because gold's gone down again. So it's just reflecting that correlation, I guess.
Has gold fallen today? Should do my research before coming on live to the Fit Finance session, shouldn't I?
But yeah, I guess on that note, that's probably enough from us. Do more research into other asset classes.
Lovely. See you all next week. Bye-bye.